What's up, TGE team? This is Ruben from TGE. And in this video, I want to talk about something that I wrote about the ATR indicator. I heard of it before. I might have used it once, but it's not that great. My friend was actually kind of referring it to me, but I was like, I don't like this at all. Because once you start using forward-looking metrics, looking at any lagging indicator is kind of like it's not the same. It's like you'll never once you go like Apple, you'll never want to go back to Windows. So I want to talk about ATR and why it's a horrible indicator. Okay, and what is a better alternative in my opinion. So let's talk about trading mistakes that are costing traders money every day. A lot of traders rely on ATR, which stands for average true range, to gauge how far a stock can move in a day. And so that's usually what I see traders use the ATR indicator for. It marks like the highest point that a stock can go for the intraday and then the lowest point. And I like the math behind it. I mean, I think a lot of these indicators. I'm a big math guy, and a lot of these indicators, it's based on math, right? But the problem with this math equation is that it relies on historical price action using highs, lows, and then closing prices. So it's like it just tries to grab the lowest low, the biggest high, and maybe over a period of 30 days, a week, or 3 days, whatever the case is, it's going to try and do some sort of like addition based on the highs and lows, and then it's going to divide based on the number of days, maybe 30, maybe 3, and then that's like your average true range, right? But here's the problem. It's backward looking. Like, who cares what happened last week? We don't care what happened last week. We want to know what price is for the future, right? The thing with ATR is that it's very one dimensional. It does not factor in implied volatility, which is forward looking, which you will never be able to get in the ATR indicator because it's based on price action from past data, right? Implied volatility is something that you have to get from the option chain itself. You have to look at the option chain and you have to look at the IV because that's going to tell you what the implied volatility forward looking is. It's an anticipating forward looking metric. So it doesn't account for like market events like earnings, FOMC, or unexpected volatility shifts. And worst of all, it ignores market maker behavior, dealer position, and option Greeks, things that actually dictate how stocks moves. Okay, this has a big effect. Option Greeks, so option premiums have a big say in how the market's going to react. Where are key levels at? Where are true support and resistance levels? Okay, where is implied volatility in the market? It doesn't account for earnings. It doesn't account for anything else, right? It's very one dimensional, very backward looking, and you can't do that when you're looking backwards. So that's like looking at yesterday's sunny day to determine whether we're going to get a storm today or not. Like it doesn't work. So here is why the expect and move is better than the ATR indicator. And it's really, really simple. It's a very simple formula that you can do yourself, okay? And this is the most basic formula to figure out an expected move of a stock by a given date. Okay, that's the thing. Okay, because this takes into consideration the option pricing, which is already most of the time like implied volatility is already baked into the option pricing, so you don't really have to do a whole lot, right? So a much better way to forecast movement is using the expected move formula. It's called the straddle. It's called expected move, or is it straddle expected move, something like that, which is derived from the option pricing. A simple model for expected move using a straddle is expected move equals at the money ask call price plus at the money ask put price. And it's just that simple. And then now you have a range to play with. And this changes on a day-to-day basis because it takes into account theta, takes into account time, it takes into account um, implied volatility and gamma and all this other good stuff. And so this is going to save you a lot. It's a lot better than the ATR, I'll tell you that. Let's say SPY is trading at 500, and you can check the at the money put options for a given expiration. Let's say it's at $8.50. Let's say the at the money put ask price is $7.50, and then all you have to do is just add these together, right? That's it. That's about $16 up or down by the expiration date. So once you have that number, you just get the current price of the stock, which is like 500 plus 16 to the upside, 500 minus 16, and that's the weekly or whatever the expiration date is, right? Could be for the day, could be 2 days from now, could be a week from now, but that is the range that you can play with by that given date from the current price that it's at. And that has about a 68-70% chance of hitting. Okay. This means, yeah, so unlike ATR, expected move accounts for future volatility. So it's really important. It reflects market pricing, not just past data, and it helps traders set a realistic target based on option flow. This is really important, okay? Because I know there's a lot of traders out there that's like, we're going to try and target the swing highs and the swing lows, and we're going to try and target uh, two up, two down, all kinds of crazy stuff. We're going to try and target the 100 MACD, all this stuff, but it's not realistic targets because it doesn't take into account implied volatility and option flow data, which again, this has a big say in when the market makers are buying and selling the underlying stock price. Okay, very, very important. So use this formula, and it's easier. You could do it yourself instead of using ATR. If you want something that's like faster, you can just use our Gextron tool. Okay, when we just use the Gextron tool, you could just see here, we pull this expiration dates out to the side, and I just give you the expected move. It's so easy. It saves you thousands and makes you thousands because you already have a higher probability of knowing where the price of the stock is going to go. So like SPY, as of right now, March 11th, has $4.87 left to move to the upside and to the downside, which is still huge for it being 1 p.m. Eastern time. Okay, so I already do that for you. You don't got to do the hard work. You just got to play the ranges, and it's based off of option flow data. It can't get any better than that. All right, how to choose the right strike. Okay, so this is really important because the main thing about ATR is setting price targets, right? But I'm telling you, that's the worst way to do it because it doesn't take into account volatility. It doesn't take into account option flow data. So by using just this simple math, like, okay, now you have a range. How do you pick the best strikes, the best targets for options, right? So once you have the proper expected move, you still need to pick the right strike. Inside TGE Max, we favor the 38 delta contract. Most of the time, within this range, you want to find a strike and an expiration date that matches a 38 delta. Okay, so for example, like if this is going to be a weekly, like the Friday expected range is $16 up, $16 down, then I want to get a couple contracts out, a couple expirations out, that and a strike that matches a 38 delta. Typically, you're going to see the 38 delta strike be somewhere within this range, the $16 range. Okay, and that will get you an out of the money contract into the money as quickly as possible, and with insurance too, with some sort of safety net. That way, you're not caught up with intraday movements and all that stuff. It's really, really simple. Why? Because it's the sweet spot. Also, 38 delta is the sweet spot where Vega is not too high, not too little. So implied volatility, it's like you're not getting. It's not so far out where price movement is going to impact the contract too little, and it's not so deep in close to the money where it's going to impact too much. Okay, it's right in the sweet spot where you hit that peak. If it offers the best, it offers the best risk to reward balance as well too, which is what I was just referring to. It aligns with the expected move probabilities, making a more strategic choice. Okay, this is really, really important. So the 38 delta, you don't really have to think about it a whole lot. I just kind of gave you the answer. Just pick the 38 delta. All right. So key takeaways: stop relying on ATR for price targets. It's really outdated. It's not good. Use expected move. This is a much better formula. The one in Gextron is a little bit different because it uses a Black-Scholes model, which also uses implied volatility. Okay, so that one's a little bit more custom, but this works just as great. Okay, if you want to do it on your own, you want something free, this is a simple math formula that works almost all the time to get true market forecasts. Okay, and then look for the 38 delta contract for optimal entries or optimal strikes. Trading is about precision, not guesswork, which is what we focus on a lot of math. Start using models that reflect real market dynamics, not just backward looking math. And again, I have nothing against the ATR. I think it's from somebody who loves math. I think it's a nice math model based on just price action, but it's not good enough. And I'm not the type of trader who wants to take guesses based on price data because the past can't dictate the or can't predict the future, right? So like I'd rather just use something that will allow me to do that. And again, this simple math formula is the trick, at least to beat the ATR. All right, that's my thoughts on the ATR. I have a couple links in the description box if you want to join TGE Max or if you just want to try out Gextron for a quick demo. I'll put the links in there in the description box, and I'll see you on the next one. Peace.